Good afternoon, everyone. It's 3:48 p.m. Pacific Standard Time. Today's date is 8/26 of 2010, and SMF Street is taking their estimate of 15% probability of double dip recession up to 35%. There are many factors for that reason. We also did a special for our SMF Street traders and our worldwide international traders, because everyone qualifies to be on SMF Street. Here on the stockmarketfunding.com website, international stock trading sign up. Please, everyone qualifies. It doesn't matter what country you live in. Everyone can be on SMF Street, and everyone can be involved in the daily trading at SMF Street with SMF Street Capital assigned to you. Simply sign up for this free 5-day trial and you'll get there. There are plenty of new things that we have up here because the website is really designed for our SMF Street traders. So basically, there are new things on the S&P 500 videos. There are bear bull ETF trading videos. There's Dow Jones Index. It's a 6-month low video, but more importantly is some of the economic things in here. And you want to watch that. And we took the GDP down to 1.5%. And we did that a year ago, our full year analysis, and that's what's going to happen. We're not wrong. One of the things I'm going to talk about is what the S&P 500 is related to as far as that double dip. Another thing you can do is hit the sign up button, and you can simply put in your name, your email, and hit sign up. Then you would be in the SMF Street system. We will not email you unless you want us to update you from time to time until you're ready to join SMF Street. 5-day free trial gets started now. Basically, a double dip brings this S&P 500 a lot lower from the original. This is where SMF called the top, right here. We were calling the top right in this move. And it's on the SMF site. Go look under indexes. We told everyone to go to cash that didn't know what they were doing, that were not qualified or educated enough to understand what we do. And what we do is that we make money off of that low, and we make money off of that failure. And the double dip would cause this S&P 500 and the retail earnings in the S&P 500, based on all of our economic indicators, would mean that publicly traded companies in the S&P 500 index, and I would be happy to show you what that index looks like. A double dip recession is going to take all of these S&P 500 companies to a lower earnings structure. We said that 2010 would be the top from the 2008 re-leveraging in the earnings, and that they would hit the trough in 2010, and we have plenty of live videos on that analysis as well. And you can always go to our stock market radio show that we put out. So that means that the current earnings, $92 to $96 a share, depending on what day it is that those earnings are not sustainable when you have a higher probability of a double dip. So we took it from 15 to 35%. That means that this whole move, the whole re-leveraging process over here, here's 829.25. That's where we started to break out. But let me tell you, the lower GDP and higher taxes in the United States of America, and the private sector is deleveraging their earnings, their standard of living is going down because we don't have the right current economic policies. And we've been telling this to people for a number of years. And the thing about it is, this was good when the stimulances were working. Sure, that was a wonderful move. But right now, we have a top. We called it. That was the double bottom right here on a monthly price action with the SMF Pro Trader bar, monthly bar right there. We can't get above it. this price level here is going to be breached. When we break that 1,000 mark, we're selling down harder. You got some short-term pit stops, so what? Nothing goes straight down. You will bounce, you will go up, and you'll continue where these highs are going to be resistance, and you're going to go lower, and you're going to come up, and you're going to make a series of lower highs. Meaning that this whole trend is going to go lower. And what it means is a double dip recession is going to cause what was once stimulated, and the stimulants have come off. There's lots of problems. The labor market's not good. We know that. There are too many things. You can't raise taxes either. Because if you're going to have a higher taxes, you're going to drive people out of the U.S. No wonder corporations have gone elsewhere, offshore, because of our system is not accommodating them. Small business in America are not being accommodated. The lending institutions are not lending. None of that is happening. We got mortgage rates at all-time lows. No one needs the money because they don't know what to do. They don't know what to believe. The stock market's a wonderful place when you know how to take that move. It's even more wonderful when they collapse. And you, SMF Street traders, have been building this top short and still remain 1 month, 2 months, 3 months, 4 months later still short on our long-term plays, and we're falling below the 10-month moving average. And the idea that the earnings trough is sustainable at a double dip level, it can all be avoided. It could be avoided. But the people that make these policies are going to have to get some smelling salt under the nose and start doing the right thing that stimulates and promotes both our capital system, our small business system, our entrepreneurship system, and the things that need to be done on what prosperity was originally designed to do. And right now, we've done everything quite the opposite because these stimuluses will never work. And I'm going to go into another video and call it part 2. So come back, SMF Street Traders, to your second video, because we're going to have a 2 or 3 part series on this failure and where the top is and what the lower end correction is from the top all the way back down here to that level. And we're coming, but you'll stop, you'll bounce, you'll stop, you'll bounce. So economically, earnings wise, and the failure to get the system moving and buying up toxic mortgage, the government's doing the wrong thing. And I think that people are getting tired of it. Stimuluses don't work. When the Novocaine wears off and there's nothing there, they go lower. Now, it can all be avoided if they do the right thing. And until that day comes, then the risk remains even greater to the downside than the upside is very limited from the 2010 reversal. Off of the 2008 lows, the party's over right now until we find out what they're going to do. You will have to sell the equity market down. You make a lot of money. You make a lot of money. You don't have to be a victim. You don't have to buy stocks and go all the way down. No one said you had to do that. What you can do, though, is you can do this. Bear market ETFs. Here. There's the SH. Right there. It's a short S&P 500. There's lots of things that you can do and participate in at SMF Street to make a lot of money. Why everyone hold and hope. Hey, it's going to come back. Maybe it will, maybe it won't. You're on the wrong side of the tape. The reality is, you're not where the money's printing. That's what SMF Street does best. But we understand it not from an opinion. We have a mathematical direct access trading system. I'm going to go to part 2